Dear students, in our previous class, we learnt about public finance meaning, scope, and the branches of public finance. Today's class, let us proceed with the same chapter, public finance, in detail, the left out headings. Let us first try to know fiscal policy and monetary policy, meaning of these two terms. Often in economics, we use the word fiscal policy as well as monetary policy. First, it is very essential for us to know meaning of fiscal and monetary with differences. Let us try to discuss them in detail. Observe the very first point. Meaning of fiscal policy. It is that branch of public finance which is concerned with framing of proper tax and expenditure policies by the government for achieving the objective of economic growth with price stability. If you analyze this complete statement, here you come across one important term, that is tax and expenditure policy. So, blindly you can analyze and think that fiscal policy is related to tax and expenditure policies of the government with a target to achieve growth with stability or economic growth with price stability. If at all asked for 1 mark, you cut it short in a simplest way. Fiscal policy is a policy which is concerned with proper tax and expenditure by the government for achieving the target of economic growth with price stability. So, fiscal is related to tax and expenditure policies. After knowing fiscal policy, it is very important for us to know what is monetary policy then. Let us discuss meaning of monetary policy. It implies a policy of the government for regulating the flow of money in an economy. See here, observe flow of money. That is, recollect when we have learnt money and banking, we have come across this. In India, the central bank is RBI. The RBI shapes the monetary policy of the country as per the directions given by the government of India, that is, finance department. Generally, the central bank of the country implements monetary policy on behalf of the government. That is, the credit control policy of the central bank is a major component of monetary policy. That is, recollect, we have discussed about the role of monetary policy during inflation and deflation in the previous chapter. So, credit control policy is a major component or instrument of monetary policy at times of inflation. How central bank clear controls through monetary policy. At times of deflation, how central bank or RBI controls the situation through monetary policy. The major differences between fiscal and monetary policies are mentioned below. Just before we go to the differences, observe the meaning in a simplest content that monetary policy refers to actions of central banks take to pursue objectives such as price stability and maximum employment, whereas fiscal policy refers to government's revenue collection and spending decisions. Here, income and expenditure decisions of the government is fiscal. What action the central bank takes in order to in order to pursue the maximum employment and price stability. Let us discuss detailedly the differences between monetary and fiscal policies. After knowing the meaning of monetary and fiscal, let us move on to the differences. Observe the table very carefully. The very first point of fiscal and monetary you come across is meaning. Observe, fiscal policy affects the revenue and expenditure of the government. Here, the key terms you need to focus in this revenue and expenditure is a key term. Whereas other side, this policy affects the aggregate money supply in an economy. So first point, fiscal affects the revenue and expenditure, monetary affects the aggregate money supply in the economy. Second, the instruments of fiscal policy are government expenditure, imposition of taxes, provision of subsidy, public debt, etc. Whereas the instruments of monetary policy are BRP, that is bank rate policy, OMO, that is open market operations, CRR, that is cash reserve ratio, SLR, statutory liquidity ratio, etc. So that means second point is concerned with instruments of fiscal and monetary policy. Come to third. Monetary policy, fiscal policy is related to reflected in the annual budget of the government. That means you know the meaning of the term budget. Last class also you made a mention of this. Budget is an annual statement of anticipated revenue and anticipated expenditure of the government for a particular financial year. Normally, how much the revenue or money expected, income expected, expenditure planned, that is always reflected in budget. Whereas monetary policy is implemented by central bank of the country, or in India central bank is RBI, and so on in other cases also. Observe next. The fiscal measures for controlling inflation include, just to control inflation, include increase in direct taxes, decrease in government expenditure, decrease in tax exemption, and subsidy payments. See, if you understand inflation, how we can control it, you will know it clearly. Just recollect, in money and banking, there is a separate heading. Long back, we have discussed what is inflation, how to control inflation. These measures already we have discussed. It's just a repetition. Just remember, to control inflation, increase in direct tax to be increased. Whereas government expenditure, tax exemptions, subsidies have to be reduced so that inflation can be controlled. How? If you analyze this, if direct taxes are increased, clear, a part of the income earner is taken away. So his purchasing power is reduced. Accordingly, demand also can be reduced. If government reduces expenditure, tax exemption and subsidy, remember, income of the people decrease, then we can control inflation. Observe the right hand side. The monetary measures to control inflation include increase in BRP, that is bank rate policy, or bank rate should be increased. CRR, SLR should also be increased. If these three measures, BRP, CRR, and SLR, are increased, we can control inflation. Again, you should not be in confusion. We have already discussed the CRR, SLR, and BRP when the RBI increases them, when it decreases. At times of inflation, it increases. Let us move on to the next one. The next point of difference between fiscal and monetary policy is that the fiscal measures economic depression include decrease decrease in direct taxes and increase in government expenditure, increase in tax exemption and subsidy payment. Just remember these points, whatever we have discussed in the previous slide. Observe just opposition. At times of inflation, direct taxes will be increased, but now it is deflation or depression. So we decrease direct taxes, whereas increase government expenditure and then tax exemption, subsidy. Just opposite you write. Whatever you have written previous, just opposite. Observe the right hand side. The monetary measures to control economic depression include decrease in BRP, CRR, and SLR. Just recollect, just in the previous slide we learned, at times of inflation, RBI increases bank rate, CRR, and SLR. Since it is depression, it decreases. Blindly remember, at times of inflation, RBI or central bank, clear, increases BRP, CRR, and SLR. Deflation or depression, it decreases. Inflation increases, deflation or depression, it decreases. Then move on to the next point of difference. This policy influences demand for and supply of goods and services in an economy. Remember, what is the, or what exactly the quantity of the goods and services demanded is influenced by fiscal policy because spending or expenditure of the government, revenue and expenditure policies determine this. So that's why it will influence the demand and supply of goods and services. But the right hand side you observe, the monetary policy influences demand for and supply of money in an economy. Observe, this influences goods and services availability. This influences the supply of money in an economy. However, despite these differences, both monetary and fiscal policies aim at higher economic growth, social justice, and price stability. Though we have clear listed certain points of difference between monetary and fiscal, both the policies aim at achieving growth, social justice, and price stability in an economy, which is the ultimate goal of the country. Now, we need to discuss the differences between public finance and private finance. Observe this slide very carefully. Public finance versus private finance. Let us move on to the next important heading and discuss it in detail. First, it is very important for us to know what is public finance and what is private finance. Then we'll go to differences. Observe, public finance, it is concerned with revenue and expenditure of the government. Just analyze public, it means government. Finance, revenue and expenditure. So simply the very word itself self-explanatory. It is concerned with revenue and expenditure of the government. Whereas private finance, it is concerned with income and expenditure of any individual or a private body. As I've already told you, revenue is nothing but income of the government. We use our revenue. So public finance deals with revenue and expenditure of the government, whereas private finance deals with income and expenditure of any one particular individual or a private body. So after knowing meaning of this public and private finance, it is very essential for us to know similarities and dissimilarities between these two. There are certain similarities and dissimilarities between public and private finance. First, let us try to understand what are the similarities. Then we'll go to dissimilarities. So, when you take up the similarities between public and private, the very first point we have almost similar objectives. Both public and private finance, their objectives are almost similar. What is it? Let us analyze, observe. The principal objective of private finance is to satisfaction of personal or individual wants. First, we have taken up this. So the very objective of private finance is to satisfy the individual or private wants. Whereas the objective of public finance, the first one, it is to satisfy the wants of all the members of a society. Even this is self-explanatory. When I say public, we are talking about either government or general public in a society. So the aim of private finance is to satisfy the wants of individual or a person, whereas the public finance aims at satisfaction of wants of all the individuals in a society. Let us move on to the second point. The second point of similarity is resource constraint. In both the cases, the resources available for the satisfaction of wants are limited. Let it be private finance or public finance, the resources are limited. The very crux or the key point of importance to be known, even you learnt in your ninth standard, here human wants are unlimited, but the resources to satisfy these human wants are limited. When the resources are limited and wants are unlimited, here comes optimum utilization of available resources. That concept, again we are bringing that here. Recollect last year's syllabus, you learnt about scarcity definition given by Lionel Robbins. There you learnt about limited resources and unlimited human wants and optimum utilization of resources. That point is a kind of repetition here. Observe, since the resources available are limited in both the cases, therefore optimum utilization of limited resources becomes the main issue before private and public. See, let it be public finance, revenue and expenditure of government, private finance, revenue and expenditure of an individual. Since the resources are limited, with the limited resources, they try to utilize these resources in an optimum manner and get maximum satisfaction. Go to point 3. Similar financial aspects. Both private and public finances are concerned with income and expenditure statements. Please focus. Income and expenditure statement is nothing but budget. Both of them face problems in raising sources of income, proper allocation of funds among different heads of expenditure. You can link this point with the previous. When both the cases have limited resources and unlimited wants, here comes optimum utilization of resources. And both public and private face problems in related to or in relation to raising of income and allocation of their funds. Come to next point, what we have is fourth, dependence on borrowing. Just ignore this part for a while. Just as an individual, clear, thinks to bridge the gap between income and expenditure. When individual's income is less, expenditure is more. To bridge the gap between income and expenditure, individual borrows. Same way, government also borrows. And that is what the public borrowing question arises. Observe here, fourth point. Borrowing may be necessary to bridge the gap between income and expenditure. This is true for both the cases, whether it is government or private, whether it is public finance or private finance. To bridge the gap between income and expenditure, borrowing becomes necessary. So this borrowing, clear, in case of government, we call it as public borrowing. In case of individual, we say private borrowing. The sources may differ, but both borrow to bridge the gap between income and expenditure.